Alright, imagine this. You open your portfolio one morning, guess what? It's red everywhere. You have headlines screaming market in a free fall, your WhatsApp groups are buzzing like bees, and your gut, it's yelling, sell now, think later. Panic button has been pressed. But here's the uncomfortable truth about our equities. That feeling that you're experiencing, it's totally normal. It shows up nearly every year. If we learn to expect it and even prepare for it, we might just catch those sweet returns that a lot of investors totally miss. Welcome to Bottom Line. Today, we're flipping our market mindset. India only, data-driven, absolutely no scare tactics. We're just going to talk cold, hard numbers and give you a clear context and, more importantly, a playbook that you can stick to when it hurts. So let's start by resetting our expectations. Look at the past decade. The Nifty 50 has taken a dip of at least 10% 10 separate times. And those dips, they're about 15% from peak to trough on an average. Now you stretch that timeline a bit, that pattern gets even more clearer. In 30 years, we've seen 19 corrections of 10% or more. So that's less than one correction per year. And of those, 8 were nasty. Now, even those one-off scary moments, they fit in a rhythm. Do you remember May to June 2006? Now, at that point of time, the Nifty plunged about 30% in just about 35 trading days, across 6 to 7 weeks. And much closer to today, sometime last year, between September 2024 to early this year in February 2025, we saw the longest losing streak in nearly 29 years. The Nifty slid down around 14% before bouncing back by late March. Now, the bottom line is, clusters of weaknesses happen. They look terrifying in real time, but they're definitely not forever. Here's a very quick snapshot of recent drops and recoveries to drive our point home. Double-digit falls, routine, but they're not rare. And also, guess what? History is showing that once the market hits bottom, it doesn't hang around there for long. So usually between 7 and 12 months, the earlier highs are back in the game completely. That's the natural heartbeat of equities. Painful drop feels endless in that moment. It's very temporary. But what sticks around? Time after time, it's that long-term upward trend. So that brings me to our second mindset shift. Returns don't trickle in evenly. They come in bursts. Just a few powerful weeks or months do a lot of that work. So Morningstar India had a look at a decade and they found all the outperformance over cash. It turns out that it came from just 8 months out of those 10 years, around 6.7% of the time. Now, if you miss those magic moments, you're basically missing why you hold equities in the first place. Let's do a quick thought exercise. Let's take 10 lakh rupees and put it in the Nifty 50 TRI, the Total Returns Index, in 2005 and hold it until 2024, about 19 years. You'll get a little over 1.4 crore rupees. That's bringing it around 14.2% CAGR. Now you miss just 10 of the best days in that whole period, your money is shrinking down to 68 lakh rupees. That's roughly 10% CAGR. Okay. And you miss the 50 best days, you're left with only 12 lakh rupees. 7 of those 10 best days, they came within 2 weeks of the market's worst days. All those gut-wrenching sell-offs, well, they're often followed by the rebounds that really build well. Trying to time your exit around those scary days means that you usually miss the bounce back. Here's a graph that makes it pretty clear. Red stretches come often, but they're shorter and shallower than the longer, bigger green climbs. And every big drop, it's followed by an even bigger, longer climb. So markets reward time in the market, not timing the market. When the market feels stuck during a drop, the feeling isn't a prediction. It's the setup. The big bursts come after the pain. So if you're out or forced out, you're missing the fireworks. Now, most of the magic doesn't happen gradually. It just hides in a few huge sessions you only see if you stay invested through the chaos. Now, if you can survive those regular dips and keep your seat when it gets uncomfortable, Indian equities have historically rewarded that patience. Now, the Nifty 50 TRI, the Total Returns Index, has delivered roughly 12.05% annualized returns over the last 25 years. And if you look closer, you look at rolling 3-year windows on the Nifty TRI, you see about 93% of those ended positive. Now, you stretch that view further, and it not only gets better, not just average returns, even the worst outcomes improve. Here's what the numbers are saying. As you hold longer, 5, 7, 10, or even 15 years, the average returns climb and the worst case losses shrink out. Now, over 10 years, average returns sit at around 10.7% with a floor of, let's say, about 3.5%. Over 15 years, the average nudges to about 10.9% and the minimum drops to about 6.9%. Now, between 99 and 24, 21 of those 26 years finished positive, almost 80% positive years. And the last decade, 9 out of 10 years were in the green with a CAGR of 12.48%. That's solid endurance. Short term, the dice aren't in your favor. Nearly 46% of single days and about 23% of 1 year windows end up negative. But you really stretch that timeline and the risk crumbles. Only about 7% of 3 year periods were negative and near zero over 7 to 10 years. Bottom line, the longer you stay in the market, the odds are in your favor. You look closely, pain now, gain later is a real pattern. After the big sell-offs, market typically bounces back hard. And on an average, falls have been about 34%. But the rebound 6 months later is about 32%. And over the next year, it's roughly 57%. Let's take the worst years. 2008, the market tanked 65%, but rebounded 77% in the next year. COVID year 2020, 40% dip, followed by a 94% recovery within a year. So yeah, corrections are brutal, almost never stick around. And recoveries, they tend to be fast. They tend to be powerful. And most of the heavy lifting is done in the 6 to 12 month time period after a fall. Those of us who stay invested, we tend to reap multi-year double-digit returns. Here are a few patterns for us to keep in mind. Not to time the markets, but to keep risk in check and stay on track. First up, right? Drawdowns are routine and rebounds are common. Now, we saw this in 2006 and in the 24-25 mini cycle. Sharp falls followed by rebounds within months. Not fun, but definitely expected. Secondly, you need to keep an eye out on the dollar index. Don't treat it like a switch though. In the last 2 decades, in the last 20 years, when the dollar index fell by more than 5%, the Nifty always finished positive with median gains around 34%. Third, back in 2017, before the NSE tweaked the Nifty's PE calculation, Capital Mind showed that when Nifty's trailing PE was near 23, 1 to 3 year returns were weaker. 5 to 10 year horizons looked even better. Bottom line, higher entry PE often means lower near-term returns. Use this as a signpost really. It's not an all or nothing signal. Then, please budget for pain. Now, plan for a 15% drop most years and the occasional 30-40% shock. The mindset line you need to have is, I can handle an X% drop without panic. And lastly, financial prudence. Ring fence your near-term needs. Keep about 6 to 24 months worth of cash outside equities so that you never have to sell in a dip. Tying it back. Volatility is just the price of entry. Time in the market, that does the heavy lifting. What do you think? Did any of those patterns change how you'd plan your next move? We'd like to know about it. Thanks for watching this edition of Bottom Line. We'll see you in the next one.